Usually when we look at a really successful business, there is this sort of expectation of creative genius.
Oh, absolutely. It looks like magic from the outside.
Right. It looks like a magic trick. You see a company launch this brilliant new product or, I don't know, an ad campaign that completely takes over the cultural zeitgeist. And you just think, wow, the management team there has incredible intuition.
Yeah, you think it's all art and inspiration.
Exactly. It feels like art.
Yeah.
It's the front of the stage, the actors, the lighting, the applause, all of that. But then you step backstage into the world of corporate finance, and suddenly that magic trick it disappears entirely.
Completely vanishing.
You realize you're looking at a landscape that is, well, honestly, it's a giant, complex, unforgiving machine of gears and pulleys.
It is the absolute definition of the hidden mechanical truth. And what's really fascinating, is how few people, even people high up in management, truly understand the physics of those gears.
Yeah, they know their own little area.
Right. They understand their specific lever, sales, marketing, HR, but they don't actually understand the engine itself.
Which is exactly why you are here with us today. So welcome to the deep dive. Whether you are prepping for a massive boardroom meeting or trying to scale a scrappy startup, or you are just someone trying to understand how the global business ecosystem actually operates behind the curtain, today's material is your ultimate operational cheat sheet.
It really is.
We have a fascinating stack source material today. It's a comprehensive, structured set of notes detailing the fundamental, completely unvarnished concepts of corporate finance.
And we're not just going to read a textbook here.
No, not at all. Our mission isn't just to recite a bunch of accounting rules. We're here to decode the secret language of business. We're going to figure out the exact mechanisms of how companies decide what to do with their money, and more importantly, how those decisions dictate whether a company actually thrives or dies.
And to decode that language, we really have to establish the absolute core objective of the entire system right at the top. The source material immediately establishes a very specific, uncompromising North Star for all of this.
Right.
The primary objective of corporate finance, the entire reason these mathematical frameworks even exist, is the maximization of company value for the shareholders.
Yeah, and that is a premise we have to just look right in the eye. Maximize shareholder value.
It's controversial for some people.
It is. To a lot of people, that phrase sounds very sterile or maybe even ruthlessly Wall Street. It strips away the romanticism of, like, changing the world or delivering customer delight. But the material is explicit. That is the objective function of the machine.
It is the singular lens through which every decision must be mathematically evaluated, period. If we connect this to the bigger picture, every other thing a company does, whether it's launching a revolutionary product, redesigning their supply chain, or deciding to pay for comprehensive employee health care, it's ultimately just a lever being pulled to achieve that one specific goal.
Maximizing the financial value for the entities that own the capital.
Exactly. If an action does not mathematically map to that goal, corporate finance theory dictates it is an inefficient use of resources. It just shouldn't be done. The theory assumes that if you maximize value, you are inherently allocating resources to their most productive uses in society.
But, realizing that every choice is, at its core, an exercise in maximizing shareholder value. That creates a massive problem for the people actually running the company.
Oh, a huge problem.
Because the high-level theory crashes into daily operational reality very, very quickly. A marketing director isn't sitting at their desk on a random Tuesday thinking about the mathematical maximization of the firm's equity.
No, they are just trying to survive their inbox.
Right. And the source material grounds this beautifully with a really concrete scenario. It introduces a case study, a business called El Olivo de Olivia, or Olivia's Olive Tree, operating under International Products.
It's a great example.
It perfectly captures the absolute barrage of seemingly unrelated questions that management is facing at any given moment. Like, let's just look at what Olivia's management team is dealing with simultaneously. Marketing bursts in and wants to know the exact budget for an aggressive new ad campaign.
Standard Tuesday.
Right. Then HR is knocking on the door, asking if there is cash liquidity to cover proposed salary increases across the board.
It's a classic operational crossfire.
It is, and it keeps going. Sales is trying to figure out how to measure the bottom line impact of a brand new commission scheme designed to incentivize volume. The strategic planning team is locked in a debate about whether they should deploy capital to open their own exclusive retail stores or...
Or if they should just try to enter massive supermarkets.
Exactly. Then procurement is wondering if they should freeze their current vendor contracts and hold a huge supplier contest to squeeze out better margins. The IT department is demanding capital for a massive new information system to track all these goals.
Everyone wants money.
Everyone. And hanging over this entire chaotic symphony is the CFO, who is sweating and asking, how in the world are we going to obtain the financing needed for all of this? And finally, how will we even know if we are on the right track?
Right. And if you look at that list of problems through a traditional management lens, you see a marketing problem, a human resources problem, a real estate problem, a technology problem. You just see silos.
Yeah, totally separate issues.
But here is where the paradigm shift happens. The framework we are exploring today forces us to look at that exact same list and realize there is no such thing as a marketing problem or an HR problem.
Aren't these actually just the exact same financial mechanism wearing different operational hats?
That is the crucial insight. The material synthesizes this chaos by boiling the entirety of corporate finance down to three main types of decisions.
Okay, what are they?
Investment decisions, financing decisions, and dividend decisions. But when you are dealing with the kind of operational barrage Olivia's team is facing, the text heavily emphasizes two fundamental dynamics, two pillars that support every single move a business makes.
Let's break down those two pillars for the listener, because understanding this changes how you look at every business article you will ever read.
Okay, pillar number one is investment decisions. The fundamental question here is, where do I invest my money? When the strategy team at Olivia's asks whether to open their own physical stores or distribute through supermarkets, they are not asking a real estate question.
No, they're not.
They are asking a pure investment question. Do we lock up our capital in multi-year brick-and-mortar leases and store fixtures, anticipating a high margin return? Or do we invest that capital into supermarket slotting fees and trade promotions, anticipating a lower margin but higher volume return?
And it's the exact same logic for the IT system, right?
Yeah.
When the chief information officer wants, say, $10 million for a new enterprise software rollout, that is an investment decision.
Yep.
The company is taking $10 million of present capital, deploying it into code and servers, with the strict expectation that the software will generate efficiencies that return more than $10 million in the future.
Exactly. You are allocating resources, you have a finite pile of capital, and an infinite number of places you could put it. Your job is to rank those opportunities by their expected return and deploy the capital accordingly. That is the first pillar.
Which brings us to the second pillar. If pillar one is where do I put the money, pillar two has to be where do I get the money?
Pillar number two is financing decisions. The fundamental question is the mirror image. Do I lend my money or borrow money? How do I get the funding I need?
Right.
When the management team asks how they are going to fund that aggressive ad campaign or that new IT system, they are making a financing decision. Do they use the retained earnings they already have sitting in the bank? Do they go to a commercial bank and take out a multi-year loan?
Or do they go to the capital markets and issue new shares of the company, bringing in cash, but diluting the current owners?
Exactly. This is such a powerful framework because it completely destroys the illusion that business strategy and finance are separate departments. Every operational decision in a business is ultimately a capital allocation decision. You literally cannot separate strategy from finance.
They are the exact same mechanism. When you decide to hire a new senior executive, you are making an investment decision. You're choosing to allocate, I don't know, $300,000 a year in capital to a human resource instead of using that money to buy a new piece of manufacturing equipment.
Yeah, you are betting that the human brain will yield a higher return on that capital than the machine would.
But if you are pulling those levers all day across a dozen different departments operating globally, how do you track the aggregate result? How do you answer that final desperate question from the CFO in the Olivia case study? How do we know we are even on the right track?
Well, you can't just look at the bank account balance.
No, definitely not.
A company can have millions in the bank and be mathematically dying, or have almost zero cash and be the most valuable startup on the planet. Management needs a highly calibrated diagnostic system. They need a dashboard.
And this brings us right into the structural core of the material, the financial dashboard. The source outlines three fundamental financial statements. And these aren't just, boring accounting obligations for the tax authorities. They are the quantifiable translation of all that management stress and strategy we just discussed.
And the material assumes we know what these statements are on a basic level, so it pushes us to understand the tensions within them. Let's look at the first dial on the dashboard, the balance sheet.
The statement of financial position. I always visualize the balance sheet as a photograph. It is a snapshot in time, a flashbulb going off at exactly 11:59 p.m. on December 31st.
A snapshot is the perfect analogy.
It freeze frames the entire company. It tells you nothing about what happened in June or August. It just tells you exactly what the company possesses and exactly what it owes at that singular millisecond in time.
It highlights the static nature of the document. It is the accumulated reality of every decision the company has ever made up to that point. And the material provides a framework using a specific example, Company ABC SA.
Right. Let's look at the actual numbers they provide for Company ABC because it grounds the theory.
Okay, so the text shows total assets of $170,200. But rather than just reading a single number, we need to look at the structural architecture of the snapshot. The left side of this architecture is the assets everything of economic value the company controls.
And the critical distinction here isn't just what the assets are, but their velocity. The material divides them strictly into current and non-current.
Velocity is exactly it. Current assets are the highly liquid resources. It's the circulatory system of the business. The text gives a figure of $78,200 for current assets.
So that's the actual cash in the bank, the short-term investments, the inventory sitting in the warehouse waiting to be sold.
And the accounts receivable, which is the money customers owe you for products they've already taken. These are resources expected to be converted into actual spendable cash within one 12-month operating cycle.
It's the fast-moving stuff. It's what keeps the lights on this week. But then you have the non-current assets.
Which, for company ABC, is $92,000.
This is the heavy machinery.
All right.
The property, the manufacturing plants, the long-term strategic investments. These are the assets that dictate the company's long-term capacity to generate wealth, but they are incredibly slow-moving. You can't pay your payroll on Friday with a brick from your factory wall.
Precisely. So you have this total pool of assets, the fast and the slow. Current plus non-current equals that total of $170,200. But the fundamental law of physics for the balance sheet, and the reason it's called a balance sheet, is causality.
Cause and effect.
The left side is what you have, but the right side is the explanation of exactly how you paid for it. Every single asset a company possesses was funded by one of two sources: borrowed money, which are liabilities, or the owner's money, which is equity. There is no magical third source of capital.
And this is where the strategic tension lives. Because just like the assets, the liabilities have velocity. You have current liabilities, the short-term debt. For company ABC, that's $61,000. This is the money you owe to your suppliers in 30 days, the payroll taxes you owe next month.
And then you have non-current liabilities, the massive long-term debt. For ABC, that's $97,000. So total liabilities are $158,000.
And then whatever is left over is the equity, or capital countable, as the text notes.
Right, $12,200 in equity. And if you add the liabilities of $158,000 to the equity of $12,200, you get
$170,200.
Yeah.
It balances perfectly with the total assets.
Exactly. The balance sheet isn't just a list of property. It is a forensic record of a company's financing decisions. It tells you how aggressively they are using debt to fuel their assets. And one of the most dangerous things a management team can do is a mismatch of velocities.
Oh, like funding a massive, slow-moving factory using a fast-moving short-term credit line.
Yes. That is corporate suicide. Because a bill for the factory comes due in 90 days, but the factory won't generate a dime of cash for 5 years. The balance sheet technically balances, but the velocity mismatch creates a fatal liquidity crunch.
Okay, so the snapshot is brilliant for assessing structural health and risk at a specific moment. But it is completely silent on performance. If I look at a photograph of a race car at the finish line, I know it finished. I don't know if it drove a smooth race or if it crashed into 3 walls to get there.
Right.
To see the story of the operating cycle, we need the second dial on the dashboard, the income statement, or estado de resultados. If the balance sheet is a photograph, the income statement is a videotape.
It measures the flow of economic value over a defined period, like January 1st to December 31st, 2021, as in the source's example. It shows how the company takes its raw inputs, runs them through the operational engine, and hopefully spits out a profit.
And the architecture of the income statement is basically a massive, cascading waterfall of subtractions. You start at the very top with sales. For ABC, the top line is a clean $1 million.
$1 million. It's a massive, beautiful number that sales teams love to put on their resumes.
But the moment that number hits the page, reality starts taking bites out of it. The top line is vanity, the bottom line is sanity.
That's a great way to put it. The first and most critical bite is the cost of sales. In the text's cascade, that takes away $400,000. This gives you your gross profit of $600,000.
It's the most brutal measure of whether your fundamental product unit economics actually makes sense.
But the bleeding doesn't stop there. Then you have to subtract the operating expenses to run the actual corporate apparatus, the rent, the salaries, the marketing. The text subtracts $150,000 for that.
Leaving an operating profit of $450,000.
Exactly. And then you add or subtract financial products, financial expenses, and other items to get the profit before taxes, which sits at $395,000.
Finally, the government takes its bite. Subtract $118,500 in taxes, and we land at the absolute bottom of the waterfall. Net income of $276,500.
You made $1 million, but you only get to keep about a quarter of it.
Exactly. But I have a huge question here, playing devil's advocate. If I have a net income of $276,500 on my income statement, isn't that my cash? Can't I just go spend that?
No, absolutely not. And that is a massive trap that ensnares even seasoned managers. Because accounting profit is not actual cash in the bank. The income statement operates on the principles of accrual accounting. It includes massive non-cash items like depreciation. When you buy a factory, you don't expense the whole thing on day one, you spread it out over years. So your net income is lowered by an expense, but no physical cash left the building that year.
Oh, or if you sell a huge contract and record the revenue, but the client hasn't actually paid the invoice yet.
Exactly. You have accounting profit, but zero cash. Which is why the material insists on the absolute primacy of the third dial on the dashboard, the statement of cash flows.
The oxygen monitor.
Yes, the text explicitly states it shows inflows and outflows, where money comes from, and if the company is actually generating cash, it strips away all the accounting theory.
And the brilliance of the cash flow statement is how it categorizes these movements, right? It mirrors the strategic pillars from Section 1. It brings cash flow down into 3 distinct areas: operating activities, investing activities, and financing activities.
Exactly. Operating cash flow is the heartbeat. The source highlights the egresos reales, or real cash outflows here, paying for raw materials, taxes, services, payroll. If your core business isn't generating more cash than it consumes in these real outflows, the engine is fundamentally broken.
Then you have investing activities, which is the cash spent on fixed assets, and financing activities, tracking the loans and dividends. So when you look at these 3 sections together, you see the true narrative of the business.
Cash is a fact, profit is an opinion.
Wow. Okay, so we have established the dashboard. We know how to read the snapshot, the video, and the oxygen monitor. But reading the dials is only half the job.
Right, you have to interpret them.
Exactly. The real job of management is evaluating whether the numbers on those dials are actually good. And that requires understanding the relationship between 3 vital forces: the Holy Trinity.
Profitability, risk, and liquidity. You cannot judge any financial result without understanding the inherent tension between these 3.
Let's lock down the definitions because the material uses these terms with absolute precision. First, profitability or rentabilidad. The capacity to generate benefits. This is relatively straightforward. You put $1 in, what comes out?
Second, liquidity or liquidez. The text defines it as the degree of ease of converting an asset to cash with the least possible loss.
Like having cash under the mattress.
Exactly. But the third force is where the paradigm completely shifts. Risk. Risco. Normal people, when they hear the word risk, think of catastrophic danger, like a fire destroying the warehouse.
But the material doesn't define risk as danger, does it?
No. It has a very specific mathematical definition. The source defines risk as the probability that expectations will be met.
The probability that expectations will be met. That is a massive conceptual leap. It's not just about losing money. It's about the variance between what you modeled in your spreadsheet and what reality actually delivers.
Exactly. Variance is the enemy of the financial system. If you project a 10% return and one year you get 20% and the next you lose 2%, even if you average out okay, you are considered wildly risky because your ability to forecast the future is flawed.
So we have this trinity: profitability, liquidity, and risk. And the fundamental, inescapable reality is that you cannot maximize all three simultaneously. It is a balancing act.
It's exactly like the classic fast, cheap, good triangle in project management. You can only pick two.
Right. If I want high liquidity, like keeping all my cash under my mattress, I have zero return and I have high inflation risk. If I want high return, I have to sacrifice liquidity. I have to go buy a factory and accept higher risk that my expectations won't be met.
The trade-offs are absolute. A management team obsessed with safety will hoard cash. Their liquidity is maximum, their risk of missing expectations is near zero, but they absolutely destroy their profitability.
The capital's just lazy.
Right. Conversely, if they chase massive profitability, they deploy all that cash into illiquid, long-term assets. They drain their liquidity and skyrocket their risk variance.
Which perfectly sets the stage for the absolute climax of the source material.
The value creation trigger.
Yes. We know the goal is to maximize shareholder value. We know the constraints of risk and liquidity. So what is the exact mathematical trigger that actually creates value?
The material is beautifully uncompromising on this. It gives us the foundational formula, the golden rule. Financial value is strictly created when the profitability of the business, the ROIC, or return on invested capital, is mathematically greater than the expected return or cost of financial resources.
The WACC, the weighted average cost of capital.
ROIC must be greater than WACC.
Let's really deconstruct this, because this is the single most important concept we will discuss today. I've often heard WACC described as the gravity of a business. It's this invisible force pulling downward, and your operational engine has to generate enough thrust just to break even.
That is a brilliant metaphor. Let's break down the gravity. WACC is simply what it costs a company to get money from the financial ecosystem. And the key word is weighted. A company usually doesn't get all its money from one place.
They use a mix of debt and equity.
Right. And those two sources have very different costs. Debt, like a bank loan, is relatively cheap. Let's say it costs 5%. And there's a fascinating quirk. Interest payments on debt are usually tax deductible. The government essentially subsidizes your borrowing.
But wait, if debt is cheap, why doesn't a company just fund 100% of its operations with debt?
Because of the risk of variance we just talked about. Debt payments are a fixed contractual obligation. The bank wants its interest regardless of the economy. If you only use debt, you maximize your risk of bankruptcy. The tension of the Trinity prevents you from using only the cheapest capital.
So you need a cushion. You need equity.
But equity is expensive. Equity investors are at the bottom of the hierarchy in bankruptcy. They take the maximum risk, so they demand the maximum expected return, say 12%.
So the CFO has to blend these costs, the cheap debt and the expensive equity. That blended rate is the WACC. Let's say it's 8%.
Okay, 8% is the gravity. Now look at the engine, ROIC. If it costs you 8% to get money, and your business generates a 12% return with that money, you have a positive spread. You are creating value.
But what if it's the other way around?
If you borrow at, say, 10%, and your operational engine only generates 6%, you are destroying value.
Even if the income statement shows a profit.
Exactly. For every dollar of capital deployed, you are destroying 4 cents of shareholder wealth. The operational profit is an illusion masking fundamental value destruction.
Wow. And the material takes this one step further, right? It introduces the magic of discounted cash flows.
Yes. Because value isn't just about today. It's about the present value of everything you will earn in the future. The text brings up the formula for present value. Future cash flow divided by 1 plus the discount rate raised to the number of periods.
The time value of money. $1 tomorrow is worth less than $1 today.
Right. You have to project all future cash flows and discount them back to today. And the discount rate used is often the WACC.
So the higher your WACC, the more severely your future cash flows are penalized.
Which means, and this is a crucial insight from the source, lowering your cost of capital inherently increases the value of the company.
Wait, really? Let me make sure I'm grasping this.
Not
So I can increase the value of my company without selling a single extra product, just by restructuring my debt to get a lower interest rate.
Yes, that is the mind-bending reality of corporate finance. By optimizing the capital structure, you reduce the denominator in that math equation, and the present value of your company skyrockets. You create wealth purely through financial engineering.
But to get that WACC down, you need access to the outside world. A company doesn't exist in a vacuum. It needs a financial system to feed it.
Which brings us to the ecosystem: markets, life cycles, and survival.
The material explains the system's fundamental mission. It's designed to capture the surplus from savers people or companies with extra money and channel it toward public or private borrowers.
It facilitates investment and manages payment mechanisms, and the text identifies three main players.
The banking system, the capital markets, and fintech. I find the inclusion of fintech really interesting because it's shaking up the traditional binary of just banks and stock markets.
It is. But regardless of the player, the financing a company can get depends entirely on where they are in their life cycle. The host introduces the life cycle chart from the text. Idea, startup at time zero, then initial and sustained growth, expansion, mature age, and finally crisis or decline.
Right, let's connect the life cycle to the financial system. Let's say I'm in the startup phase.
In the startup phase, you have zero liquidity, zero profitability, and astronomical risk variance. Traditional banks will reject you. You rely on expensive equity like angel investors. Your WACC is punishingly high.
But then I hit the expansion phase.
Now you have assets and cash flow. The risk drops. You can access what the text calls expansion financing. You issue bonds or do an IPO. Your WACC drops and you grow rapidly.
What about when I become a massive legacy company, the mature age?
You require replacement financing. You aren't conquering new markets, you're just maintaining the machinery and paying dividends. Your risk is tiny, and your capital is incredibly cheap.
But then, the final phase, crisis mode.
Right. When revenues collapse, risk spikes, the banks cut your credit, the cost of capital skyrockets just when you need it most. This introduces a very dark term from the text: vulture financing.
Vulture financing, that sounds brutal.
It is. Distressed debt funds swoop in, buy your debt for pennies, force you into bankruptcy, wipe out the equity holders, and seize the assets.
And the material anchors all of this theory to a specific historical case study, right?
Yeah.
The documentary series Gigantes de la Industria, or The Men Who Built America.
Yes, chapter 6.
While the text doesn't provide the plot of the video, we can use it as a thematic anchor. Think about the titans of industry. Vanderbilt, Rockefeller, Carnegie. They didn't just build better products.
No, they mastered corporate finance. They mastered capital allocation.
Exactly. They navigated the financial systems to fund massive expansion. Rockefeller manipulated his capital structure so well that his WACC was lower than anyone else's. When a crisis hit, he became the vulture financier, buying up his competitors for pennies.
Whoever controls the cost of capital controls the industry.
Man, we have unpacked a tremendous amount today. Let's recap the journey for you, the listener. We started with the everyday stress of management, quantified it into 3 financial statements on a dashboard, weighted against the trinity of risk, return, and liquidity.
We found the magic formula for value creation, ROIC greater than WACC.
Right. And we tracked it through a company's entire lifespan, all the way to vulture financing.
To close, I want to leave the listener with 2 direct quotes from the source materials reflections section.
Let's hear them.
The first is, when everything seems to fail, the best path is to return to the sources.
Return to the foundational physics. I love that.
And the second is, to solve a problem, nothing is better than a good theory.
Nothing is better than a good theory. So I challenge you, the listener. The next time you see a company making a bizarre decision, like launching a weird product or laying off staff while profits are high, don't look at their marketing.
Look at their WACC.
Look at their life cycle stage.
Yeah.
Ask yourself, are they creating value or are they just trying to survive vulture financing? Because the theory explains the reality. Thanks for joining us on this deep dive.